Pride of authorship kills many deals. And so if you're stuck on it has to be a share sale under this structure, this, that, the other thing, the probability of us being able to get a deal done diminishes greatly. If you're very rigid about the terms you're willing to accept, right, it makes getting the deal done a lot harder. If we have Tom, Dick, Harry, Lou, and Sally that are all decision makers and are all deciding whether or not they want to sell the business, well, that makes it very difficult to get a deal done. Good afternoon, Raph here is Zatara Transaction Advisors here out of Saskatoon. I figured I'd just talk about the deal term risk items that we kind of put in our valuation and why they matter, right? So number one would be accepting of terms. If you're very rigid about the terms you're willing to accept, right, it makes getting the deal done a lot harder, right? If you're not willing to, let's say the business doesn't have many assets and it's not very bankable, so it's difficult to attain financing for it, and you're not willing to accept terms, you want 100% cash at close, this, that, the other thing. You don't want to be there for the training and transition. You know what I mean? You want all your money and you want out, and you're not willing to take any risk. Well, obviously that's going to have a serious impact on the price of the business. What we can reasonably expect to get when selling your business, right? Same with multiple decision makers. Well, if we have Tom, Dick, Harry, Lou, and Sally that are all decision makers and are all deciding whether or not they want to sell the business, well, obviously that makes it very difficult to get a deal done because you're not just negotiating with one person, right? You have 5 different people who all have 5 different objectives when selling the business. They all have 5 different things that they think are the most important when selling the business. So obviously when you have a bunch of different people you have to make happy, it's hard to make everyone happy. So obviously if there's only one decision maker, there's not very much risk. That one decision maker is going to make the decision, and that's that. But if you have 10 different decision makers and 10 kids and 25 spouses, or you understand what I'm saying. If you have a whole bunch of different people that are making the decisions, it becomes very difficult to make everybody happy. Same with the training and transition plan. Well, if you're not willing to help them integrate the business, or depending on if it's a larger company, integrate the business. If it's if it's just an individual who's buying it, by a larger company, I mean a larger buyer who has a bunch of businesses and maybe an industry buyer, they may not require the training and transition. Or if the company's large enough, right, where you have a good management structure in place, you're not really involved in any of the day-to-day, it kind of runs itself, then the training and transition plan may not be all that important because the same management is going to keep running the business. And obviously when that's the case, that increases the price. But if you have an individual who's buying your business and you're an active part of the business, well, obviously if you're not willing to help them keep running the business, if you're not willing to help them or teach them how to treat your baby, that's going to have a serious decrease on the price because it's going to hinder the goodwill, right? There's not as much the future value beyond what they're actually buying, the assets that they're actually buying isn't there. It's severely diminished, right? And you can get paid for training and transition, right? So the more flexible you are with these things, right, the easier it is to sell your business. Financeability, I guess a couple things on bankability of a business. There's a couple different types of lenders. You'll see your cash flow lenders. This is like institutional lenders, so banks, right? You'll see your cash flow lenders and your asset-based lenders. They have 2 different kind of lending methodologies. Cash flow lenders are going to look at the amount of free cash flow in the business. So that is cash flow from operations minus the cash flow from investment, or plus the cash flow from investment, depending on if you're restructuring the business, you might be getting rid of a bunch of assets. So there might be money coming in there, but Who knows? And then you have your cash flow from financing activities. So they're going to look at all that, and they're going to look at the debt service ratio, right? So they're going to look at basically what they like to do is they like to take EBITDA and divide it by the debt service, and they want to see, or the debt cost, right? Whatever payments you have to make, right? And that's principal and interest, P&I, right? So they want to see that you have a debt service ratio of, they'll tell you 1.25, but a lot of times it's close to like 1.5, maybe higher even. With real estate, it's going to be lower, right? And I guess the other thing too, well, I guess we'll talk about that on the asset side. With the assets, what they want to do is they want to be 100% collateralized. And so they're only going to lend against tangible assets. And what I mean by that is property, plant, and equipment, and then real estate. And they will typically do what I've seen is, 50% of the property, plant, and equipment, or 75% property, plant, and equipment, depending, and then up to 80% on the real estate, right? So they'll tell you, we'll do, depending on the bank. Some banks are more flexible with it, where they'll do 75% loan to value, right? Oftentimes, though, it's important and I got caught on this once upon a time. It's important to remember that they're not going to take inventory into consideration on the value that they're lending against. Anyways, so the more financeable your business is, obviously that'll increase the price, because the more the buyer can borrow, the less they have to have down, right? And then depending on what they're lending against, what the bank is lending against, that's going to determine what the payment's going to be and what the interest rate's going to be. So the amortization length, and then also the interest rate, right? So with real estate, they might go 25 years out, but with no real estate and just the assets, with some of it unsecured, obviously they'll do whatever secured and whatever unsecured. On a typical business loan, it might be only 8 years out, 8 years amortization. That's it. So the business has to be able to pay itself back in 8 years at, right now, I think the going rate's like 9%, 8 to 9%. And obviously that's all risk-based too, right? The bank's going to do their own risk analysis, and from that, they're going to determine what interest rate is reasonable, what they should be asking for, right? So that's the financeability. And then the commitment to sell. You got to be, if you're going to go to market and you're going to sell your business, you got to actually be committed to getting out, and you got to be committed to selling. And so there are times where at the end you'll get to almost closing date, and the seller decides, I'm going to hold on to it because now my kid is somewhat interested after I told him I was selling it. Well, that's a big no bueno, because everybody's invested a huge amount of money in doing the diligence and getting everything ready to sell your business. And now, 9 months down the process, the typical sale lasts around 9 months. So 9 months in, you decide, I don't want to sell. And so the buyer's now spent, maybe 2 months, 3 months in negotiations, and another 3 months on diligence and getting the financing and paying all these professional fees and financing fees to get everything lined up. And you pull out. So that's a big, big deal. It's obviously, if you're not committed to sell, it's going to decrease the price. Plain and simple. And then the other thing I was going to mention is kind of in this accepting of terms. Pride of authorship kills many deals. Pride of authorship kills many deals. And so if you're stuck on, it has to be a share sale under this structure, this, that, the other thing, the probability of us being able to get a deal done diminishes greatly, right? At the end of the day is what the buyer is willing to pay. All that being said, we can maximum, a lot of times, at least what I find in the Saskatchewan market here, people are more than flexible on, how we structure the thing to make sure that we maximize the amount of cash for both parties. So somewhat minimize the cash outlay for the purchaser and maximize the disposition for the seller. And that balance right there, right? Because you have the lifetime capital gains exemption. Anyways, so all that being said, these are the deal term risk factors that we kind of add into our valuation, because most of the time we're trying to determine the price that a reasonable person is going to be paying for your business, right? So all these things we kind of put into our little algorithm, these risk factors, to determine what the most probable selling price is going to be. I just want to go over that. God bless you. Take care. And yeah, ciao.